Welcome back to the Deep Dive. We're here to sift through the noise, unpack the key details from a whole stack of sources, and basically give you that shortcut to being really well informed. Today, we're plunging headfirst into, well, a really comprehensive stack looking at India's economy. Recent policy, economic numbers, global ripples. It's all in here. We've got a snapshot of some genuinely fascinating and frankly sometimes surprising changes. Okay, let's unpack this.
Yeah, and what's fascinating here, I think, is just the sheer breadth of it all. We're not just skimming. We're digging into national policy reforms, economic performance data, global trade stuff, capital market shifts, the works. And our mission, really, for this deep dive is to boil it down, find the critical insights, connect the dots for you, and help understand not just what's happening, but, why it matters, give you that informed perspective.
Absolutely. The goal is to really get into these recent government reforms in India, the key economic signs, market trends, and then, crucially, link that all up to the bigger international picture. What does it all mean for you? Whether you're just curious, maybe looking for investment angles, or, prepping for that big meeting. So let's jump right in. Major policy shifts first. These are really reshaping the landscape over there. First up, goods and services tax, GST, big reforms. They're moving from 4 tiers down to a simpler 2-tier system, mostly 5% and 18%. Now, this isn't just admin, is it? Feels like a calculated move, but what's the strategy behind something that could potentially cost the government, what, $480 billion?
Yeah, that's the figure. Around $5.5 billion, or maybe negative 0.15% of GDP.
And how does that actually ripple down to household budgets, maybe in ways we don't immediately see?
Right. If we connect this to the bigger picture, that potential revenue loss, it really does suggest a very deliberate government play. It's not tinkering. It looks like a bold move to boost consumption by making things, cheaper. Essentials, even some discretionary stuff. Think about it. Hair oil, shampoo, toothpaste, butter, cheese, prepackaged snacks, cooking gear, baby things, medical diapers. Even sewing machine parts, lots of those were at 18%, now dropping to 5%. For a household watching its budget, that actually frees up a bit of cash, doesn't it?
Yeah, that's a tangible difference day to day. And it goes beyond just those pantry items, right?
Exactly. Healthcare, education, too. Essentials like thermometers, medical oxygen, diagnostic kits, even things like maps, charts, globes, pencils, notebooks. They're seeing rates drop, sometimes from 18% to 5% or 12% down to nil, zero tax. So it supports those critical areas. And then you've got electronics and cars, a drop from 28% to 18% for things like air conditioners, bigger TVs, monitors, projectors, dishwashers, and various types of vehicles, too. Petrol, diesel, CNG hybrids, three-wheelers, motorcycles. It's pretty broad.
Okay, now here's where it gets really interesting and maybe a bit counterintuitive. They've brought in a new 40% GST slab for super luxury and sin goods. Pan masala, tobacco, fancy cars, high-end bikes. Makes sense. But the overall tax on luxury cars actually falls from nearly 50% down to 40% because they remove some specific extra taxes, cesses. Why the break for luxury cars?
That's a sharp observation. It really points to a kind of multi-layered approach here. Yes, sin goods are clearly being targeted with higher taxes, probably for social reasons, health reasons. But the reduction on luxury cars, it suggests maybe a rethink about how those high-value items fit in. Removing those cesses could be about simplifying the structure, even for luxury goods, maybe to boost that specific segment or streamline imports, perhaps. It's definitely a balancing act, not just hiking taxes on everything expensive.
Interesting nuance. So, GST touches almost everyone. Let's switch gears to another area impacting millions, but differently. Online gaming. The government reforms here, well, they've been seismic, haven't they?
Oh, absolutely. Some really impactful changes. Specifically, a ban on online money gaming involving actual stakes. And importantly, this includes skill-based games, too. Things like fantasy sports, poker. They're caught in this.
Wow.
The effect was instant. You called it seismic, spot on. Many popular platforms saw their Android downloads just plummet. 75%, even 100% drops for some.
100%?
Yeah.
Just stop dead?
Pretty much, yeah. It really shows the direct, immediate power policy can have.
That is staggering. But then you see a big player like Dream 11. They pivoted fast, went to free-to-play, looked internationally, and their installs apparently nearly doubled. That's quick adaptation.
It is a striking example.
So what's the thinking behind such tough rules on a booming industry? And how's the government trying to manage this digital space that just evolves so quickly?
This raises an important question, doesn't it? How do governments keep up with these digital industries? Well, part of the answer is setting up this National Online Gaming Commission, the NOGC. That's for licensing, for regulation, trying to bring some structure. At the same time, they've criminalized promoting, advertising, even handling financial transactions for these banned platforms. That's a very strong signal. The rationale, well, it's certainly looking at the societal impacts, worries about addiction, financial problems for people, consumer protection needs. Essentially, the government's trying to balance that economic potential and innovation against the potential social costs, setting up a framework really for how they'll handle these complex digital sectors going forward.
Right, makes sense. And beyond those big headlines, there are other legislative moves sort of quietly setting the stage for future growth too, like the mining bill. This isn't just tweaking rules, feels more strategic, about resource independence. It helps explore and extract critical minerals, lithium, cobalt, nickel, graphite, stuff needed for EV batteries, defense tech, everything. And they removed a 50% cap on selling from captive mines. What's the urgency for India to control its own supply of these minerals?
Well, the urgency is largely global, I'd say. There's intense international competition for these minerals right now. They're absolutely foundational for the green transition, for advanced manufacturing. Just relying on imports creates big vulnerabilities, geopolitical risks, supply chain issues. We've seen that. So by removing that cap and also increasing the royalty contributions from leaseholders, they're encouraging more exploration, yes, but also making sure more of what's mined stays in India for domestic needs, not just for export. It's about building self-reliance, really, in a world scrambling for these resources.
Got it. And then there's the income tax amendment bill. Significant for individuals, right? Exempting earnings up to $1.2 million under the new tax regime. Plus, introducing faceless assessments. So your tax stuff is digital, anonymous, less human interaction, maybe less corruption.
And removing penalties for small taxpayers, too. Sounds like moves to simplify things, encourage people to comply.
Precisely. That's the goal. Streamline the process, reduce the friction, make it more taxpayer-friendly. Faceless assessments, especially, that's a big step towards more transparency, minimizing that discretionary power, which can be a real issue, and removing penalties for small taxpayers. It just encourages them to engage without fear. It all helps build a more efficient, maybe more equitable tax system, which supports the economy overall.
Okay, policy covered. Let's look at the numbers. What are they telling us about broader economic performance? India's GDP growth Q1 FY26 was strong, 7.8%. Agriculture up 3.7%, manufacturing up 7.7%. Sounds pretty good.
It does sound robust, yeah. But when you peel it back, look at India's listed companies for that same quarter. I get a sense of a more complex story, almost a counter-narrative. How do we square that circle? Is it a contradiction, or does it show something about different parts of the economy?
You've really hit on a key point there. While that 7.8% GDP figure is strong headline news, digging into the listed companies for Q1 FY26 shows, yeah, a much more mixed picture. Overall, their revenue growth actually slowed down 6%. And profit after tax, POT, their net earnings, down 9% year on year. Now, a big part of that was because of some one-off gains in the previous year, which makes the current numbers look weaker by comparison. So it's less a contradiction, maybe more an indication of concentrated growth.
Concentrated growth. Okay, so who was doing well?
Right. Within that mix, definite gainers. Gold retailers, for instance. Revenue up almost 30%. Net profit soared 45%. Strong demand there. Consumer discretionary, especially alcohol, did well too. Revenue up nearly 11%. Profit up 11%. And financial services, excluding banks, they had impressive growth. Revenue up about 15%. Net profit climbed over 20%.
So clear winners. But I assume there were losers too.
Indeed. Definitely some significant headwinds elsewhere. Aviation, for example. Revenue plummeted 52%. Net profit down a huge 68.5% year over year. Probably fuel costs, maybe changing travel habits. Packaging was also down significantly. Revenue off 29%, profit down 44%. Even industrial capital goods faced challenges. Revenue down over 8%, profit down over 30%. What's really striking is that just a few sectors, cement was up 47%, utilities up 13%, tech and oil and gas up 7%, they were the main engines. They contributed something like 71% of the incremental earnings for the Nifty index.
71%, wow.
Yeah, it shows a very concentrated growth pattern. Not all parts of the economy firing on all cylinders at the same time.
That concentration is fascinating. It has a lot of nuance. And speaking of trends, we are seeing some signs, maybe, of a slowdown in the capital market, particularly from foreign investors. Promoters' ownership in private listed companies, that fell to an 8-year low, 40.9% as of June 30th. And maybe more telling, foreign institutional investors, FIIs, those big global funds, they pulled out a massive euro, $350 billion from Indian stocks in August. Their sharpest exit this year. Year-to-date outflows are now over $1.3 trillion. That feels like a warning sign, doesn't it?
It could definitely be read that way. I mean, it's a significant chunk of capital leaving the market, no doubt. However, and this is where the market dynamics get really interesting, that's not the whole story. While FIIs have been pulling back, domestic investor activity has been incredibly strong. It's acting as a really powerful counterbalance. Domestic institutional investors, DIIs, that's the local funds, they invested a huge $948.3 billion in August. That's a record for a 25-month buying streak. They just kept buying. Plus, we saw a record new fund offer NFO collections in July, $304 billion. That pushed equity mutual fund inflows to an all-time high of $426.7 billion.
All-time high, yeah.
Yeah. This dynamic is crucial. It shows the growing resilience, maybe sophistication of domestic capital in India, especially with systematic investment plans, SIPs, from retail investors. The stoppage ratio, the rate at which people stop their SIPs, actually fell in July, so sustained commitment there.
Yeah.
So it's not just local money replacing foreign money. It suggests a maturing market where domestic investors are increasingly able to absorb those foreign outflows. It demonstrates real underlying strength. So what does this all mean? It indicates, I think, a market finding its own solid internal footing.
That domestic resilience point is key, a strong internal market.
Yeah.
But could relying so much on domestic capital become a vulnerability if foreign investment stays away long term? Or is this really a new, more self-reliant phase for India?
That's a really insightful question. Look, a healthy flow of FII money is generally good for liquidity, global integration, all that. But the growing strength of DIIs and retail participation via SEPs, it suggests a deeper, more stable foundation, perhaps. It makes the market less dependent on potentially fickle foreign flows, less vulnerable to external shocks, maybe. So rather than a vulnerability, many actually see this as a sign of a more self-reliant, more mature financial ecosystem developing in India, one that can potentially sustain growth even when global capital gets nervous. It's a pretty significant shift in the market's character.
A powerful picture of an evolving market. Okay, let's shift to the RBI monetary policy update. The central bank kept its neutral stance. Repo rate held at 5.50%, second pause in a row. They kept the GDP growth forecast for FY26 at 6.5%, but interestingly, they revised the inflation forecast down to 3.1%. What's this neutral stance signaling for the future, and what's behind that lower inflation forecast?
The RBI's neutral stance, plus holding the rate steady, it really signals a focus on broader stability, trying to balance growth and inflation control without making sudden moves. That downward revision on inflation, it suggests they're seeing some easing of price pressures. Could be moderating commodity prices, maybe supply chains improving a bit. What's also quite notable is the banking system's liquidity surplus. It rose to $4 trillion in August. That's a lot of liquidity.
Over a trillion, wow.
Yeah, it provides a strong cushion for the financial system, supports lending, even while the central bank stays cautious but stable, shows the system's pretty well buffered right now.
All right, let's drill down into some specific sectors now, starting with banking. The microfinance gross loan portfolio, GLP, it grew, up 17% year over year, nearly 6% quarter over quarter, reaching $3.6 trillion. Sounds right.
Surface, yeah.
But underneath that, some worrying signs. Active loan accounts dropped massively, from 159 million down to 80 million. The live customer base shrank by 7%, and the portfolio at risk, PAR 180 plus funds, loans overdue more than 180 days, including write-offs, that rose to 12.4%. So GLP growing, but fewer active accounts and rising risk.
Yeah.
That feels like a paradox. What's really happening in microfinance?
It is a bit of a paradox, and it points to a really complex, challenging situation, almost like a dual crisis brewing there. While the total loan book is growing, that huge drop in active accounts and customers, it suggests a contraction in the actual reach. Fewer new borrowers getting these loans. The GLP growth seems driven more by existing clients taking bigger loans or maybe repeat loans, or just the value increasing over time. At the same time, that rise in PI 180 plus to 12.4%, that's a clear signal of rising delinquencies, growing credit stress. The industry knows this. They're actually pushing for a pretty big government guarantee scheme, maybe 150, 200 billion, to sort of de-risk lending and encourage new credit flow. And looking more broadly at banking, we're seeing overall bank credit growth slow down a bit, 10.2% in August. Net interest margins, NIMs, a key profit measure for banks, hit a 3-year low of 2.9%. And crucially, loan loss provisioning the money banks set aside for potential bad loans that jumped 16% quarter on quarter, a 3-year high. Taken together, these figures definitely suggest potential stress building up in parts of the lending system. Needs watching.
Clear signs for caution there. Okay, moving to consumption. Some interesting indicators here, maybe pointing to muted consumer confidence in certain spots, affordable housing share and new project launches. dropped dramatically. It
Hmm.
was 40% in 2019, now just 12% in the first half of 2025.
Big drop.
Domestic air travel was down 3% year-over-year in July, and autos, passenger vehicle dispatches, down 7% year-over-year in August. That's the fourth month in a row of decline. Major players saw drops. Maruti Suzuki down 8%, Hyundai down 11%, Tata Motors down 7%. What's driving this softness in discretionary spending?
Yeah, these numbers definitely suggest a softening in discretionary areas and some sector-specific issues, too. The drop in car dispatches, for instance, well, part of that is likely automakers deliberately cutting shipments because they were anticipating those revised GST rates we talked about.
Ah, right. Didn't want to get stuck with old stock.
Exactly. It shows a direct link between policy shifts and industry behavior, creating these short-term wobbles. Plus, reports suggest festive season sales for things like consumer durables were slow. Buyer inquiries apparently down 50–60%. So it creates a challenging climate for those discretionary sectors. Suggests that even while the overall economy grows, consumer confidence in some areas is still a bit shaky. Maybe inflation worries, maybe a wait-and-see attitude.
But it's not all caution and headwinds. Let's look at government initiatives and CAPEX. This feels like a strong counter-narrative, pointing to future growth. Infrastructure. Cabinets approved some huge projects. A $216 billion highway, $58 billion for Lucknow's metro, a $15 billion greenfield airport. Massive investments.
Foundational stuff, yeah.
And then manufacturing and make in India. They're expanding the rare earth magnet scheme $50 billion, quadrupling the target. 4 new semiconductor projects, adding $46 billion investment. That brings the total to $1.6 trillion across 10 units planned. Huge.
Serious commitment there.
Plus a massive $620 billion order for homegrown Tejas fighter jets. And maybe the biggest headline grabber, Apple planning to make all 4 iPhone 17 models across 5 plants in India.
Yeah, that's significant.
That feels like a genuine game changer for electronics manufacturing there, doesn't it?
Yeah.
What's the long view behind these colossal spending plans?
This is really where India's long-term economic strategy comes into focus, I think. These initiatives, this CAPEX, it's foundational. The emphasis is clearly on boosting domestic manufacturing, aiming for strategic autonomy, especially in critical areas, semis, defense, electronics, Apple deciding to make all its iPhone 17s in India. That's not just a headline, it's a massive vote of confidence. It could potentially pull in an entire ecosystem of suppliers, component makers.
Right.
These aren't small projects. They represent huge capital outlays designed to drive job creation, industrial growth, export potential down the line. It creates that powerful forward-looking story against the current consumption softness. And it's attracting foreign money too. Remember, Japan's $68 billion pledge over the next decade shows international confidence in that long-term trajectory.
Okay, quickly on trade policy updates. Seeing some protective moves, anti-dumping duties on steel from Vietnam, extended duties on a chemical, TDI from the EU, Saudi Arabia, but also some easing lower minimum export prices for honey, import duty exemptions for raw cotton. What's the strategy with this mix of protection and facilitation?
It's that nuanced approach again, isn't it? Trying to balance protecting domestic industries from what they see as unfair competition, hence the anti-dumping duties, but also making trade easier for key commodities like honey or raw cotton, which are important inputs or exports for specific sectors. It's about tweaking the trade environment where needed. And this is relevant when you look at commodity trends too, like silver up about 36% year to date, doing much better than gold's 31%. That narrowed the gold-silver ratio quite a bit. And HSBC is forecasting a big silver shortfall for 2025, predicting a price around $35 an ounce. These commodity price shifts feed directly into import costs, export competitiveness, adds another layer to those trade decisions.
All right, let's widen the lens now. International update. How does India fit into the global picture? U.S. national debt's top $32 trillion. Fiscal pressures mounting there. We're seeing China use critical mineral export controls that's already hitting Western defense manufacturing. China is also bringing in anti-involution measures, basically trying to stop destructive internal competition, overcapacity in sectors like steel, EVs. They're also trying to boost consumption, more retail investors, interest subsidies on loans, and energy-wise, OPEC Plus agreed to up oil output slightly in September. How do these global threads connect back to India?
Well, these global events create a really dynamic, complex backdrop for India, both challenges and potentially opportunities. Take the U.S. tightening semiconductor export controls. Even though they exempted key players like Samsung, TSMC, that could still influence India's own push into electronics manufacturing. Maybe create supply chain gaps India could fill. Or maybe just increase competition. China's economic adjustments, trying to boost domestic consumption, tackle overcapacity that will definitely impact global trade. It affects demand for commodities, for finished goods that India imports and exports. If China cuts back production because of overcapacity, maybe that opens up space for Indian manufacturers. Or if their consumption drive works, maybe more demand for Indian goods. It cuts both ways.
Right.
And OPEC plus upping oil output, even slightly. That influences global oil prices, which directly hits India's large import bill. So yeah, if we connect this to the bigger picture, these global shifts definitely create challenges, but also significant openings for India's trade and manufacturing goals as it tries to navigate this rapidly changing world stage.
Wow. Okay, that was definitely a whirlwind tour. India's economy, its place in the world. We've covered a lot. Ambitious reforms, shifting markets, some mixed economic signals. So what's the big takeaway? What's the core message for us?
I think the key takeaway is that India is absolutely going through a period of major structural change, no doubt about it. Policy decisions, GST, gaming rules, infra spending, trade tweaks are having real impacts, from daily life stuff right up to strategic industries. And yes, while some sectors are facing definite headwinds, we saw that in consumption, parts of banking, the government's big initiatives, and that strong domestic investment we talked about, they continue to drive that long-term growth story, that resilience. It's a really dynamic, evolving picture of a nation actively trying to shape its economic destiny. And maybe this leaves us with a provocative thought for you, the listener, to chew on. As India navigates all this, the domestic policy shifts, the global economic waves, what sector do you think will be the most surprising gainer, or maybe the most surprising loser in the coming year? And why?
That's a fantastic question to end on. Thank you for joining us on this deep dive. We'll catch you next time with more insights.